Just a short while ago, SCHD wasn't just popular, it was the dividend king everyone couldn't stop talking about. It crushed the market, delivered rock-solid income growth, and pulled in massive investor demand. But suddenly, the script has flipped. SCHD is trailing the market, its dividend growth has cooled, and its latest rebalance, increasing its exposure to energy, has left many investors confused, frustrated, and questioning whether the glory days are over. By the end of this video, you'll know whether SCHD's recent performance is a buying opportunity or the clearest signal to step away. What you're about to discover in this video is the kind of truth nobody online has the courage to say out loud. This is beyond yield or SCHD performance. I went deep into the data, every chart, every metric, every hidden detail to uncover what's really happening with SCHD and the exact shift smart investors are making right now. By the end of this video, you won't just rethink your SCHD portfolio, you'll question everything you thought you knew about it. Buckle up. This is the video you've been waiting for. Quick disclaimer, this video is for educational purposes only. I'm not a licensed financial advisor. Always do your own research or consult a licensed financial advisor before making any investment decisions. To understand why SCHD is in such a condition today, we need to look at the path that brought it here. The rise and fall of SCHD's reputation. SCHD wasn't always the ETF everyone loves to criticize. For most of its life since 2011, it was the star of the dividend world, the fund that felt almost unreal. It pulled off the impossible, outperforming the market while sticking to a strict formula of quality, stability, and reliable payouts. Achieving that kind of balance isn't supposed to be doable. Yet SCHD did it for more than 10 straight years. From its inception through early 2022, SCHD accumulated an impressive track record. It beat the S&P 500 through multiple market cycles. It raised its dividend every single year at rates that often exceeded 10% annually. It attracted billions in assets as word spread about this fund that seemed to have cracked the code on combining income and growth. The truly impressive part was how SCHD achieved those returns. It wasn't gambling on speculative growth stocks or taking on excessive risk. Instead, it focused on boring, profitable companies with strong balance sheets and consistent dividend payments, the kind of businesses investors could rely on. Then 2022 happened, and SCHD really proved its worth. While the S&P 500 got crushed, dropping nearly 20% as growth stocks imploded and tech stocks collapsed under rising interest rates, SCHD held up remarkably well. The fund was down only about 3% for the year. Suddenly, everyone wanted defensive dividend strategies. SCHD looked like a genius investment. But that moment of triumph planted the seeds for today's negativity. Because what happened next completely reversed the script. Starting in late 2022 and accelerating through 2023 all the way into 2025, the market shifted into one of the most concentrated surges we've seen in years. The driver was clear: artificial intelligence. With the launch of ChatGPT in November 2022, investors suddenly raced to get exposure to AI infrastructure, AI software, AI everywhere. The S&P 500 took off, driven almost entirely by a handful of mega-cap tech stocks. Nvidia became a verb. Microsoft, Meta, Amazon, Google, and Apple all surged to new heights. The index nearly doubled from its 2022 lows, but SCHD went up about 12% over the same period and has essentially traded sideways for over a year now. This created a brutal psychological dynamic for SCHD holders. Every day, we watched our portfolio barely move while friends, family, and random strangers on the internet posted screenshots of massive gains from tech stocks. The FOMO became overwhelming, and when people experience FOMO, they don't just quietly sell and move on. They get angry. They feel like they've been tricked or left behind. The criticism kept getting louder. Investors pointed to SCHD's decision to sell Broadcom before it went on a massive run. They noted the fund's increased allocation to energy stocks right before oil prices softened. Every portfolio decision that didn't work out perfectly became evidence that SCHD was broken, outdated, or poorly managed. The fund's dividend growth also slowed significantly. After years of double-digit increases, the payout growth rate dropped to mid-single digits. For income investors who had been spoiled by those big raises, this felt like a massive disappointment, even though 5 to 6% dividend growth is actually quite solid historically. And this is where things really started to go south for SCHD. Every negative data point got magnified on social media. YouTube videos titled "Why I'm Exiting SCHD" racked up tens of thousands of views. Comment sections were flooded with people venting, agreeing, and suggesting alternatives. The story became a feedback loop. SCHD is failing, and everyone believes it's failing. But narratives and reality aren't always the same thing. So let's look at what's actually inside SCHD right now and why it is performing badly currently. SCHD isn't some mysterious black box. It's a passively managed index fund that follows a clear, systematic strategy. Understanding how it selects stocks is crucial to evaluating whether the current negativity makes sense. The fund screens for U.S. companies that have paid dividends for at least 10 consecutive years. Already, this eliminates most high-flying growth stocks and speculative names. It's looking for established businesses with proven staying power. From that universe, SCHD scores companies on 4 fundamental factors: strong cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. It's looking for companies that generate strong cash flow relative to their debt, use shareholder capital efficiently, pay meaningful dividends, and have a track record of raising those dividends over time. The fund then ranks all eligible companies by their composite score and selects the top 100. This reconstitution happens every March, so the portfolio gets refreshed annually to reflect changing fundamentals and market conditions. What does all this turmoil actually lead to? Let's take a close look at SCHD's current portfolio and the story it's telling. The top holding is Merck at around 5% of the fund. You've got other major positions in companies like AbbVie, Chevron, Amgen, PepsiCo, Coca-Cola, Lockheed Martin, Verizon, Home Depot, and Texas Instruments. The top 10 holdings represent about 40% of the portfolio, which is actually similar to the S&P 500's concentration level. But the composition couldn't be more different. When you scan through SCHD's holdings, you see a lot of healthcare, financials, consumer staples, industrials, and energy. You see very little technology, especially compared to the broader market. Cisco and Texas Instruments make appearances, but you won't find Nvidia, Meta, Amazon, or Google anywhere in this fund. Tesla, not a chance. These aren't bad businesses. Most of them are excellent businesses. Coca-Cola has been paying dividends since 1920. Chevron is one of the most financially disciplined energy majors in the world. Lockheed Martin has a defense backlog measured in hundreds of billions of dollars. Home Depot dominates home improvement retail. These are real companies generating massive amounts of actual cash flow right now, but they're not exciting. They're not tied to the hottest theme in the market. And in a momentum-driven market, that's been a massive handicap. You'd be shocked how few investors know the real reason SCHD is struggling right now. Here's one of the major reasons behind SCHD's underperformance you probably don't know. Technology represents just 8% of SCHD's portfolio, while in the S&P 500, technology is over 30% of the index. That's a massive difference, and it's been the defining difference between winners and losers over the past 2 years. Within that small tech allocation, SCHD doesn't even own the right names. Cisco has gotten some benefit from AI infrastructure spending, but Texas Instruments makes chips for cars, appliances, and industrial equipment. It has essentially zero exposure to the AI boom. So even SCHD's technology exposure hasn't helped. Meanwhile, SCHD is heavily weighted towards sectors that have struggled. Consumer staples, which make up a significant portion of the portfolio, have faced a tough environment with many companies under pressure as inflation-conscious consumers shift to more affordable alternatives. These food companies are caught in a painful squeeze. They've raised prices to offset their own rising input costs, but consumers are pushing back. Market share is eroding. Volume growth is weak or negative, and investors have decided they don't want to own these stocks at any price. Energy is another complicated position. SCHD carries sizable stakes in oil and gas companies names like Chevron, ConocoPhillips, and EOG Resources. Those energy bets paid off when oil surged, but since then, energy stocks have slowed down. Uncertainty around long-term demand, shifting global energy trends, supply decisions, and broader economic headwinds have all kept the energy sector in a rough trading range. Healthcare is a mixed bag inside SCHD. The fund still holds major players in the sector. Firms with diversified healthcare business and strong dividends, but over time, SCHD has trimmed or removed some strong pharma names. This means the healthcare segment now carries a mix of stable healthcare businesses and companies facing industry-specific headwinds. Overall, while some parts of healthcare and SCHD have held up, the sector hasn't acted as a consistent market leader. This sector mix leaves SCHD almost completely out of the AI boom that's been driving market gains. Instead, it's tied to the real economy, food, energy, healthcare, industrials, and telecom. And the market has spoken loud and clear. Right now, it doesn't reward the real economy. It wants AI, semiconductors, cloud computing, and digital advertising. Here's where things get interesting. Despite underperformance, the companies inside SCHD are trading at valuations that look tempting by historical standards. The fund's dividend yield sits well above what many broad market funds offer, and its price-to-earnings ratio is considerably lower than growth-heavy benchmarks, suggesting that a lot of SCHD's holdings are potentially undervalued right now. Now look at what's happening in the broader market. The S&P 500's forward price-to-earnings ratio has climbed to levels not seen since the dot-com era, far above its long-term average. Tech has stretched even further, with valuations pushing into territory rarely reached outside major market peaks. And while today's tech leaders actually generate real profits, unlike many companies during the late 90s, the message is still the same. The expectations built into current prices are extremely high. SCHD sits on the opposite end of that spectrum. Expectations are low, valuations are reasonable, in some cases cheap. Cash flow is strong. The businesses are not failing, they're simply out of favor. One legitimate concern investors might have is whether SCHD's dividend income is actually safe given the struggling stock prices of its holdings. This is worth examining carefully because dividend cuts are devastating for income investors. Looking at the portfolio through a dividend safety lens, the picture is actually better than you might expect given the fund's underperformance. About 65% of SCHD's dividend income comes from companies rated as having safe or very safe dividends based on payout ratios, cash flow coverage, balance sheet strength, and business stability. About 27% of SCHD's income comes from companies sitting in the almost safe zone. Their dividends look stable for now, but there are underlying pressures, things like tighter margins, higher payout ratios, or heavier debt loads. They'll probably maintain their payouts, but they're the group you keep an eye on. Just around 8% of SCHD's income comes from companies rated unsafe or very unsafe, where there's a real chance of a dividend cut in the next economic cycle. This distribution is actually quite solid for a passively managed fund. It suggests that while SCHD's stock price performance has been disappointing, the actual income generation ability of the portfolio remains largely intact. Companies are still generating cash flow, still covering their dividends comfortably, and in most cases, still raising their payouts even if the growth rate has slowed. The truth about SCHD's underperformance isn't really about the fund at all. It's about market structure and how dramatically concentrated market returns have become. Did you realize the 10 largest stocks in the S&P 500 now control almost 40% of the entire index? That level of concentration is something you usually only see near major market extremes. And over the last 2 years, nearly all the market's gains have come from this small, elite group of companies. If you don't own Nvidia, Microsoft, Apple, Meta, Amazon, Google, and a few others, you've essentially missed the entire rally. It doesn't matter how well your other holdings performed. It doesn't matter if you picked good companies with strong fundamentals. If you weren't in those specific names, you lagged. Not financial advice. This is the environment SCHD has been competing in. And it's an environment where a diversified, fundamentals-based dividend strategy had no chance of keeping up. SCHD's strategy explicitly avoids concentration in high-growth, high-valuation stocks. But why? I have no idea. In fact, it's designed to own a broad portfolio of established businesses trading at reasonable prices with strong cash generation. Most people completely overlook the fact that this SCHD strategy has worked brilliantly over long periods. But in an environment where 7 stocks drive all returns, it's completely out of sync with market momentum. The question is whether this represents a fundamental failure or a temporary mismatch. If you've been investing for more than one market cycle, the current environment might feel familiar. We've seen periods before where a small group of beloved stocks dominated returns while everything else languished. In the late 1990s, tech and telecom stocks dominated the market. Many of these firms had little to no earnings, yet investors poured money into them, banking on hype, growth potential, and future dominance instead of profits or dividends. With valuations soaring far above what fundamentals could justify, value and dividend-based investing took a back seat. It was a period when fundamentals were largely ignored until reality snapped back. Then the bubble burst. From 2000 to 2002, the Nasdaq collapsed by nearly 80%. Many high-flying tech names vanished. Meanwhile, the boring dividend-paying companies that had been ignored outperformed dramatically. Value strategies had one of the best runs in investing history. The pattern repeated in different forms. In 2007, financial stocks and real estate dominated before collapsing in 2008 to 2009. In the early 2010, everyone wanted emerging markets and commodities before both sectors entered brutal bear markets. Market cycles tend to punish the previous winners and reward the previous losers. Extremes in valuation and sentiment eventually correct. The only question is timing, which nobody can predict with precision. Right now, we're in a period of extreme concentration, extreme valuations in technology, and extreme sentiment against traditional dividend strategies. That doesn't guarantee an imminent reversal, but it does suggest that risk is accumulating in crowded trades while potential opportunity is building in neglected areas. In just the past few weeks, signs of a sentiment shift have begun to emerge. The Nasdaq has taken a noticeable tumble, and the S&P 500 has slid alongside it as investors react to renewed worries over lofty valuations, rising skepticism on AI spending, and economic uncertainty. Is this the start of a broader reversal? Maybe, but for now, it's only a signal, not a guarantee. SCHD during that same period stayed essentially flat. While tech stocks got hammered, the defensive positioning and reasonable valuations in SCHD's portfolio provided stability. It's a reminder that when risk appetite declines, the characteristics SCHD offers become valuable again. This doesn't mean the trend has definitively reversed. 1 week of market action doesn't change a multi-year pattern. But it does illustrate that SCHD's defensive characteristics still work when investors want them. The fund hasn't lost its ability to provide stability and income. The market just hasn't cared about those attributes for a while. Before you even think about getting bullish, we need to confront the uncomfortable truth. The case against SCHD is stronger than most people want to admit, and ignoring it could be a huge mistake. If you're convinced the AI wave is just getting started, then SCHD simply isn't built for the world we're heading into. This fund is intentionally constructed to avoid the hypergrowth, high-valuation, AI-heavy names that are powering the market right now. So if AI continues to dominate, you won't fall behind because you picked the wrong ETF, you'll fall behind because SCHD was never designed to chase the very traits that are winning. Here's a brutal truth most people don't want to accept. Some of the weaknesses inside SCHD's portfolio might not just bounce back. The consumer staples space, one of SCHD's biggest anchors, could be undergoing a permanent shift. People are spending more on experiences and less on packaged goods. Store brands are eating into the market share of the big names. And if these trends aren't just a phase but a long-term reality, that pressure doesn't magically go away. It becomes a drag that sticks. And then there's the part income-focused investors hate to talk about. Dividend growth has slowed hard. We're no longer seeing those powerful double-digit increases SCHD built its reputation on. Now it's hovering around mid-single digits. If someone is counting on that dividend to grow fast enough to keep up with rising costs of living, this slowdown isn't a minor inconvenience. It's a real, structural problem. You probably haven't been told this, but SCHD rebalancing decisions haven't all worked out well. Selling Broadcom before its massive AI-driven rally was unfortunate timing. Increasing energy exposure right before oil prices softened was also poorly timed. While these decisions followed the systematic strategy, they've hurt returns. Now let's flip the script, because the bull case isn't just strong, it's electrifying. and it's built on a few explosive pillars that completely change the narrative. First, mean reversion is one of the most reliable forces in financial markets. When sentiment and valuations reach extremes, they eventually correct. The current divergence between growth and value, between technology and everything else, is at historical extremes. The probability of mean reversion is high, even if timing is uncertain. Second, SCHD offers a 4% dividend yield, which is the highest the fund has yielded in years. That yield is backed by real cash flows from profitable businesses. In an environment where 10-year treasury yields are around 4.5%, SCHD offers comparable income with potential for capital appreciation and dividend growth. The risk-reward looks attractive. Third, the businesses in SCHD's portfolio are generally high quality and many are undervalued. Companies like Coca-Cola, Chevron, and Merck aren't going away. They generate strong amounts of cash flow, return capital to shareholders, and have proven staying power. Current prices reflect pessimism that may be overdone. Fourth, SCHD provides diversification away from the most crowded trade in the market. If you already have exposure to megacap tech through other holdings or through broad market index funds, SCHD offers something different. It reduces your concentration risk. And for investors who focus on income, SCHD delivers reliable and relatively safe dividends. The 4% yield is meaningful. The dividend growth, while slower than before, continues, and the safety profile remains solid. For retirees or anyone needing portfolio income, SCHD serves its purpose well. The current negativity creates opportunity. When everyone hates something, prices reflect maximum pessimism. You're buying when expectations are low and sentiment is poor. That's typically when future returns are highest, even if the near-term performance remains choppy. So who's SCHD actually built for right now? That really comes down to what you're trying to accomplish, how long you're investing for, and how you handle volatility. If you're the type of investor who wants reliable income showing up in your account consistently, not years from now, but on a regular basis, SCHD is built for that. Its dependable yield, combined with gradual dividend growth, creates a cash flow that can keep up with everyday expenses. And because the fund leans toward stable defensive companies, it has a track record of cushioning the impact when the market gets shaky. Have you noticed how most portfolios are glued to the same handful of megacap tech names? SCHD appeals to investors who see value in overlooked, high-quality companies trading at fair prices and think, this is where the real opportunity sits. It's for those willing to be early, patient, and a little contrarian. It's also the perfect choice if you want less dependence on tech dominance. SCHD gives you exposure to sectors that move differently, creating breathing room and helping reduce the risk of being overly concentrated in one corner of the market. If your goal is fast growth, explosive returns, or riding the AI and megacap tech wave, SCHD is not for you. This fund isn't chasing the names driving the market, it's deliberately avoiding them. You'll lag, not because you picked wrong, but because the strategy itself isn't built for high-flying growth. If you can't tolerate patience, underperformance, or periods where your portfolio barely moves, steer clear. SCHD rewards the calm, contrarian investor. Anyone who panics after a few months of lagging will end up regretting the ride. If you're focused on beating inflation with rapid wealth accumulation rather than steady income and stability, SCHD's slow dividend growth and measured pace simply won't deliver the thrills or velocity you're looking for. The bottom line. Everyone dislike SCHD right now, and the reasons are understandable. The fund has significantly underperformed the market during one of the strongest bull runs in history. Its dividend growth has slowed. Its sector positioning looks completely wrong for the current environment. The negativity is real and backed by actual performance data. In investing, dislike and opportunity often go hand in hand. SCHD hasn't fundamentally broken. The companies in its portfolio are still solid. Valuations are looking more appealing, and the dividend yield is sitting at multi-year highs. Ironically, the very traits that held it back during a momentum-driven market, defensive positioning, sensible valuations, high-quality businesses, and a focus on cash flow are exactly the traits that tend to shine when the market's leadership shifts. Nobody knows when that rotation will happen. It might happen next month, next quarter, or next year. Or it might not happen at all, though history suggests that would be unusual. What we do know is that SCHD is priced for pessimism right now, and pessimism creates opportunity for patient investors. If you're investing for income, want diversification, value quality businesses at reasonable prices, and can handle near-term underperformance, SCHD deserves consideration. The current negativity might be exactly what makes it interesting. But if you are chasing momentum, need to keep pace with tech-driven markets, or can't stomach continued lagging, SCHD isn't the right choice for you right now. The key is being honest about your own goals, time horizon, and temperament. Don't buy SCHD because you think you're smarter than the market and can time a reversal perfectly. Buy it if it fits your long-term strategy, if you believe in its fundamental approach, and if you can be patient through difficult performance periods. Because in investing, what everyone hates today is often what everyone wishes they'd bought tomorrow. The question is whether you have the conviction and patience to find out. I'm not telling you to buy or sell SCHD. This isn't financial advice. I'm just sharing my take to give perspective and maybe spark some ideas for your own thinking. If you're interested in seeing how a small portfolio can grow over time, check out the video I linked above where I break down a strategy for growing small investments. It's packed with practical insights anyone can use. I'll see you there.